Imagine checking your investment account after a decade, seeing the balance has doubled, and yet realizing you are actually poorer than when you started. This is the profound paradox of the modern financial system, driven by a silent, relentless force that erodes wealth without ever touching your nominal balance. We are uncovering inflation, the unseen threat that quietly dismantles long-term portfolio growth while masquerading as simple economic progress. By understanding its hidden mechanics, we can transform a vulnerable collection of investments into a fortified engine for true, lasting wealth. The most dangerous financial misconception is the profound belief that a stagnant pile of cash is perfectly safe from harm. While a high-yield savings account or a physical steel vault might protect your money from daily stock market volatility, it offers absolutely zero defense against the steady decay of your purchasing power, which is the actual amount of goods and services that a unit of currency can buy. When prices rise across the broader economy, the intrinsic value of every uninvested dollar shrinks, meaning your perceived safety is actually a guaranteed slow-motion loss. To truly understand this relentless decay, we must look to the architects of modern monetary policy, specifically powerful institutions like the Federal Reserve. Central banks actively manage the money supply and manipulate interest rates to maintain broader economic stability, often explicitly targeting a modest annual inflation rate to encourage consumer spending and corporate investment. However, this intentional systemic devaluation means that the baseline expectation for your hard-earned money is a constant, deliberate loss of value over time. The historical severity of this dynamic becomes chillingly clear when we examine the economic landscape of the 1970s. During this highly volatile decade, widely remembered as the Great Inflation, massive geopolitical oil shocks and expansive monetary policies sent consumer prices spiraling violently out of control. Investors who firmly believed their accumulated wealth was completely secure were stunned as double-digit inflation rates aggressively and systematically hollowed out the real value of their life savings. Consider a highly conservative investor during that specific 1970s era who parked their entire fortune in standard bank savings accounts and fixed-rate government bonds. On paper, they reliably received their promised interest payments, and their nominal account balance slowly ticked upward year after relentless year. Yet, when they finally attempted to buy a home, purchase a vehicle, or comfortably fund their retirement, they discovered their expanded numerical balance bought significantly less than their original principal could have a decade prior. This stark historical lesson exposes the severe inherent vulnerability embedded in traditional fixed-income investments during periods of rapidly rising prices. When inflation significantly outpaces the yield generated by a corporate bond or a bank certificate of deposit, the investor experiences a devastating negative real return. This negative real return represents the actual mathematical loss of wealth after adjusting for inflation, turning so-called safe harbor assets into hidden traps that silently bleed away your financial future. Defeating this silent wealth erosion requires a fundamental, uncompromising shift in how we measure investment success, moving entirely away from nominal gains to ruthlessly focusing on real returns. A real return is simply the actual profit your investments generate minus the prevailing rate of economic inflation. If your portfolio grows by 8% while inflation runs at a hot 5%, your true wealth has only expanded by 3%, making real return the solitary metric that accurately reflects your financial progress. Historically, the most effective and reliable engine for generating positive real returns over multiple decades has been the global stock market. Equities represent fractional ownership in living, breathing companies that can dynamically adapt to economic shifts, often possessing the pricing power necessary to pass increased production costs directly on to consumers. When a dominant company successfully raises its prices in tandem with inflation, its revenue and earnings grow nominally, which in turn helps protect and elevate the underlying value of its shares. For most individual investors, the most mathematically efficient way to capture this broad corporate resilience is through an index fund, which is a pooled investment vehicle designed to passively track the performance of a specific market benchmark. like the S&P 500. By simultaneously holding tiny fractions of hundreds of different leading companies, an index fund delivers the aggregate pricing power of the entire market. This systematic approach effectively eliminates the immense unnecessary risk of trying to pick individual corporate winners during unpredictable economic storms. The staggering contrast between holding decaying cash and holding a broad market index fund becomes exponential over decades due to the remarkable mechanics of compounding interest. Compounding interest is the powerful financial phenomenon where the earnings on your initial investments generate their own additional earnings as time passes, while inflation compounds negatively, accelerating the steady destruction of your purchasing power. A well-structured equity portfolio compounds positively, creating a geometric growth curve that historically outpaces the rising cost of living. Constructing a highly resilient, long-term portfolio capable of withstanding these pressures requires deliberate and strategic asset allocation. Asset allocation is the rigorous, mathematical process of dividing your investment capital among different asset classes, such as stocks, bonds, and real estate, to perfectly balance risk and reward according to your specific time horizon. A portfolio heavily weighted toward global equities offers robust, aggressive defense against inflation, while carefully selected fixed income assets provide necessary emotional ballast during inevitable market downturns. This critical structural balance relies heavily on the foundational principle of diversification, which is the essential risk management strategy of spreading your capital across various investments to ensure that a localized failure does not destroy your entire wealth. True, effective diversification goes far beyond merely owning many different technology stocks. It involves owning entirely of assets that react uniquely to the exact same macroeconomic pressures. When unexpected inflation spikes, highly diversified portfolios absorb the shock far better than concentrated vulnerable ones. Beyond traditional equities, tangible physical assets often play a critical stabilizing role in a comprehensive inflation-resistant strategy. Commercial and residential real estate, for example, historically demonstrates a remarkably strong correlation with rising inflation, as property values and monthly rental incomes tend to naturally increase alongside the broader cost of living. Because real estate is a hard, finite asset with intrinsic daily utility, it inherently resists the rapid devaluation that plagues fiat currencies, offering a robust secondary layer of portfolio defense. Yet the frantic pursuit of inflation protection carries its own severe psychological pitfalls, most notably the dangerous paradox of safety. When terrifying inflation headlines dominate the financial news cycle, panicked investors often liquidate their proven growth assets to blindly hoard physical gold or stockpile cash, ironically locking in their temporary losses and guaranteeing the permanent destruction of their purchasing power. Yielding to this emotional fear severely disrupts the mathematical advantage of long-term compounding, turning temporary economic turbulence into permanent financial damage. Instead of succumbing to panic, sophisticated modern investors utilize specialized financial instruments designed explicitly to mathematically neutralize inflation. Treasury inflation-protected securities, commonly known throughout the industry as TIPS, are a unique class of government bonds whose principal value automatically adjusts upward in direct, guaranteed correlation with the consumer price index. By strategically incorporating TIPS into the fixed income portion of a portfolio, an investor guarantees that at least a dedicated segment of their capital will explicitly keep pace with rising consumer prices. The absolute necessity of utilizing these specialized defensive tools becomes evident when we analyze the complex aftermath of the 2008 global financial crisis. Central banks engaged in completely unprecedented quantitative easing, flooding the global economy with massive liquidity and sparking widespread immediate fears of hyperinflation. While that specific consumer inflation remained surprisingly dormant for years, eventually the sheer volume of capital in the system violently collided with global supply chain disruptions, proving that inflationary pressures can quietly build for a decade before finally erupting. Navigating these sudden, violent market eruptions requires a clear understanding of market capitalization, which is the total dollar value of all a company's outstanding shares, calculated by multiplying the current stock price by the total number of shares. During highly inflationary periods, massive large-cap companies often possess the established global supply chains and dominant market share required to easily absorb massive price shocks. Conversely, smaller-cap companies might severely struggle with rapidly rising borrowing costs, making the size of the companies in your portfolio a crucial defensive consideration. It is a highly dangerous oversimplification to blindly assume that all equities provide equal, uniform shelter from the raging inflation storm. Growth stocks, whose high market valuations depend heavily on massive distant future earnings, are often severely punished when inflation drives interest rates higher, aggressively discounting the present value of those future profits. Value stocks, which are established companies currently priced below their intrinsic worth and often generating strong immediate cash flows, historically demonstrate far greater resilience when the cost of capital suddenly spikes. Grasping these highly nuanced market mechanics completely liberates you from the exhausting anxiety of daily economic headlines. When you deeply understand exactly how different asset classes react to a rapidly devaluing currency, inflation transforms from a terrifying, uncontrollable monster into a highly predictable environmental condition. This profound comprehension fosters the ironclad emotional discipline required to stay fully invested during chaotic, frightening market cycles, which is the ultimate, undeniable hallmark of a successful, enduring wealth-building strategy. Maintaining this strategic defensive posture requires the highly disciplined, periodic practice of portfolio rebalancing. As inflation aggressively distorts asset prices, pushing certain equities higher while violently suppressing bond values, your carefully planned asset allocation will naturally drift dangerously off course by systematically selling a small portion of your outperforming assets to buy more of your underperforming ones. You force yourself to mathematically buy low and sell high, locking in your hard-earned gains while perfectly restoring your portfolio's optimal defensive stance. We must also meticulously account for the insidious, often ignored way inflation interacts with the government tax code to further erode your accumulated wealth. Capital gains taxes are aggressively levied on your nominal investment returns, completely ignoring the mathematical reality that inflation may have already consumed the vast majority of that apparent profit. If you sell an asset for a 10% nominal gain, but inflation was 8%, you're still heavily taxed on the full 10%, meaning the government effectively taxes you on the pure illusion of wealth. Successfully defending against this relentless multi-front assault requires a holistic, entirely uncompromising approach to portfolio construction. It absolutely demands the aggressive compounding growth engine of broad market equities, the targeted mathematical defense of inflation-protected securities, and the stabilizing historical presence of tangible physical assets. By seamlessly weaving these disparate financial elements together through rigorous asset allocation and highly disciplined rebalancing, we create an impenetrable financial fortress capable of withstanding the relentless invisible siege of rising prices. The ultimate path to lasting financial mastery does not require impossibly predicting the future. It requires systematically preparing for the inevitable. Inflation will undoubtedly continue its silent, destructive march, relentlessly testing the structural integrity of your wealth over the coming decades. By clearly recognizing this unseen threat and deploying evidence-based, highly resilient investment strategies, you take absolute, unwavering control of your financial destiny, ensuring that your long-term portfolio growth translates into true, enduring purchasing power.